There is a country on the other side of the world that most investors have stopped paying attention to. No headlines about it trend. No politician mentions it at a podium. And that is exactly why it is dangerous, because the biggest threats to money have never announced themselves. They wait in the quiet corners of the system, in the parts everyone assumes are stable, until one day the ground moves and nobody understands why. That corner, right now, is Japan. Not Japanese stocks, not Japanese technology, Japanese government bonds, the most boring asset class in the world, the one your finance professor skipped past to get to something more exciting. But boring is where power hides. The people who actually move markets were never interested in excitement. They were interested in leverage. And Japan just handed the world a leverage problem 3 decades in the making. To understand why, you have to go back to the late 1980s, when Japan was supposed to be the future. Real estate in Tokyo was valued at levels so extreme that the land under the Imperial Palace was, on paper, worth more than the entire state of California. Stocks soared. Banks lent as if the growth would never end. Then, almost overnight, it did end. The bubble burst, prices collapsed, and Japan spent the next 3 decades trying to spend and cut its way back to normal. A period so long and so strange that economists eventually just started calling it Japan's lost decades. Here is the setup. For most of the last 30 years, Japan lived in a world the rest of the global economy never experienced. After its asset bubble collapsed in the early 1990s, Japan fell into a prolonged stretch of weak growth and falling prices. The central bank's answer was to push interest rates down to 0, then below 0, and hold them there. When that still wasn't enough, they went further, deliberately capping the yield on government bonds through a policy known as yield curve control, engineering the price of the nation's own debt so precisely that Japanese bonds became almost a fixed, guaranteed thing. Predictable. Cheap. Dead calm and dead calm markets create a very specific kind of opportunity for people who know how to read power, not headlines. If you can borrow money in Japan for next to nothing and the rest of the world is paying real interest rates, you don't need a genius strategy. You need a bank account and a passport. Borrow yen at near 0 cost. Convert it. Deploy it into higher yielding assets somewhere else. American treasuries, global stocks, emerging markets, crypto. Pocket the difference. This is the yen carry trade, and over decades it grew into one of the largest, quietest sources of liquidity the global financial system has ever run on. Estimates put the scale in the trillions of dollars. Trillions built on a single assumption, that Japan would stay cheap forever. Forever just got shorter. Japanese government bond yields are no longer behaving the way they behaved for 30 years. 10-year yields have climbed to levels not seen since 2008. 20-year yields are at multi-decade highs. 30-year and 40-year bonds have pushed into territory never recorded since those instruments were first issued. This did not happen quietly by accident. It followed a large new government stimulus package worth roughly $110 billion, raising fresh questions about how much debt Japan is willing to issue and at what price the market will actually accept it. For the first time in a generation, holding money in yen at home in Japan is starting to pay something, and that single fact threatens to unravel the entire trade built on the opposite assumption. Because here is how unwinding actually works. And this is the part almost nobody explains clearly. It isn't a switch. It's a stampede that starts quietly and ends loudly. As Japanese yields rise, the incentive to keep capital parked overseas weakens. Institutions that borrowed cheap yen start facing a more expensive loan. The safest move, the disciplined move, becomes bringing that money home. But when enough large players make the same disciplined move at the same time, it stops being disciplined. It becomes a rush. Currencies swing. Leveraged positions get force closed. Assets that had nothing to do with Japan on the surface, American tech stocks, Bitcoin, corporate credit, get sold anyway, simply because they were funded by the same cheap yen that is no longer cheap. This is not theory. It has already happened before, and markets remember exactly how fast it moved. In the late 1990s, a sudden unwind of yen-funded positions helped trigger the collapse of a hedge fund so large that its failure nearly took the American financial system down with it. In more recent memory, a sharp, sudden strengthening of the yen wiped out global stock markets in a matter of days, catching traders who had never even heard the words carry trade completely off guard. Each time, the pattern was identical. Years of quiet, cheap borrowing, followed by hours of violent unwinding. The setup is patient. The unwind never is. Now add the second piece of leverage most people never even see. Japan isn't just a source of cheap borrowed money. It is also the largest foreign holder of United States government debt on earth. Over $1 trillion in treasuries, accumulated across decades of exactly the kind of overseas investing the carry trade encouraged. If Japanese institutions have less appetite to hold foreign bonds, because their own bonds finally pay something, the natural buyer of American debt gets smaller at the exact moment the American government is issuing more of it than ever to fund its own deficits. Fewer buyers, more supply. That is not a footnote. That is upward pressure on the borrowing costs of the largest economy in the world, transmitted quietly through a country most people never think about. Think about what that actually means. The government spending the most money in the world just lost a little of its quietest, most reliable buyer. Not because that buyer stopped believing in American debt, but because a better, safer option finally opened up back home. Debt doesn't disappear when demand for it weakens. It just gets more expensive to sell, and someone always pays that extra cost through higher borrowing rates for mortgages, for businesses, for governments themselves. This is the part that separates people who understand power from people who only understand headlines. The visible story is always simple. Inflation, elections, a central bank meeting. The real story runs underneath it, in the plumbing nobody photographs. Interest rate differentials, currency funding costs, the unglamorous mechanics of who is lending to whom and at what price, and what happens the moment that price changes. Empires and fortunes have both been built and dismantled in exactly this kind of unseen machinery. Not in the news cycle, but in the spread between two numbers most people have never looked at in their life. So what does this actually mean for you? Sitting outside all of it, watching your portfolio, your savings, your plans. It means the calm you are used to was never guaranteed. It was rented, quietly, from a country holding interest rates at zero for 30 straight years. That rent is now going up. It does not mean collapse is certain, and it does not mean panic is useful. Panic is what happens to people who only discover the game after it has already moved. What it means is that the assets you hold, the leverage you carry, the confidence you have in safe correlations, all deserve a second, colder look. Ask where the cheap money underneath your portfolio actually came from. Ask what happens to your positions if that source gets more expensive. Notice which of your holdings only look uncorrelated because the same invisible funding has been propping all of them up at once. Because when that funding reverses, everything that depended on it tends to fall together, no matter how diversified it looked on paper. The people who come out ahead in moments like this were never the loudest in the room. They were the ones who understood the structure early, positioned quietly, kept enough liquidity to act instead of react, and let everyone else discover the news a year later. Because that has always been the real divide in finance. It was never between the rich and the poor. It was between those who watch the stage and those who watch what's moving behind the curtain. Japan just moved behind the curtain. The question now is, who is paying attention? If this kind of thinking, reading power before it becomes news, is how you want to see markets from now on, subscribe. Because this is exactly the lens we use every single week.